On Business Incorporated today. In Nigeria, saving and lending gap widens by 25.33% in March. And Algeria suspends foreign trade in products and services with Spain. And then we'll take a look at South African economy as it grows to pre-pandemic levels. Hello and welcome to the program. I'm Amy John Mekwa. This is Business Incorporated. We start off as usual with market numbers from Africa, with sentiments where most of the markets were trading were negative at intraday. Nigeria's NGX continues in that bearish sentiment that is ended with yesterday, but the loss is still on a marginal level. While South Africa's index took a much deeper fall, inching close to 1%. Egypt's equities market closed Thursday, but didn't lose out in that bearish trade. Same with Kenya, which also closed down 0.11%. We head to the Middle East now, where major equities were mostly positive. That's a flip of what's going on in Africa at intraday. The United Arab Emirates and the Abu Dhabi index were down 0.16%, while Dubai gained 0.08%, still within the region. Saudi Arabia and Qatari exchanges, which are closed today, Friday, were positive at the close of trade on Thursday, as both indexes gained 0.06% and 1.04% each. Let's go to Europe now, and we have Janelle joining us now. Well, Janelle, good afternoon. We do hear that the Bundesbank has cut its growth projection for Germany economy in half. Well, it shouldn't come as a surprise at this time, but take us through the numbers.
Things certainly have looked better before for Europe's biggest economy. The country's central bank released a growth forecast today that shows Germany expanding by 1.9% this year. That is, of course, less than the 4.2% it had previously forecast in December. For 2023, the Bundesbank is now expecting 2.4%, down from 3.2%. Now, these numbers are slightly more positive than the European Commission's growth forecast for Germany this year. The European Commission had said 1.6%. Now, growth projections aren't the only numbers the German central bank has come out with today. It's also predicting that inflation is going to rise to 7.1% overall this year, sharply up from previous predictions of 3.6%. So just outlining that again, the Bundesbank has halved its growth projection for Germany and doubled its forecast for inflation, two things that very much relate to each other. The Bundesbank already says that its forecasts are based on the assumption that the war in Ukraine doesn't get any worse and the effects don't deepen.
Well, we do hope it doesn't get any worse. But from these numbers now, what are the biggest concerns for German economy?
The risks around Russia's war on Ukraine make forecasting an even more uncertain exercise as usual. But Germany's export-oriented, manufacturing-based economy makes it especially vulnerable to supply chain disruptions as parts and tech essential for production don't arrive. And obviously, it's not just the war. China's zero-COVID strategy has made itself felt on German manufacturers' bottom lines as well. China, of course, being an important source and a destination market. That said, the Bundesbank does expect high energy prices and supply chain problems to become more manageable. At the same time, consumers are still expected to have savings reserves from the time that they were not able to spend a lot during the pandemic. It's also the summer holiday season here. People are spending on touristic pursuits. That's money still flowing into the economy. However, higher prices are hitting consumer confidence and dampening consumption. In any case, slowed growth is a reality to face in Germany, which has enjoyed prosperity and a model that's worked for very long.
And so this morning, earlier, we saw that European stock markets dropped. Of course, economic anxiety hits stocks. Is
We're
it
at the
looking
end
any
of a
better?
week of mostly downbeat trading. You can really feel economists and analysts and market watchers running out of ways to say there's little relief to be found from fears over inflation, fears that inflation could tip economies into recession. Now, yesterday, we heard about the European Central Bank finally starting to get in line behind central banks around the world to raise interest rates, which, of course, is to combat inflation, but has also triggered anxiety on the market over what would happen to countries in the Eurozone with higher debt levels. The ECB has made plans to convince markets it can handle this particular question, but nobody heard much in terms of a plan yesterday, and that then helped cause the euro to fall against the dollar, which tells you something about the level of risks, both real and perceived, that the eurozone is facing.
All right, Janelle. Well, the weekend will certainly be a time to watch and see, and then we'll be back on Monday. Thank you so much. Enjoy your weekend. Well, from Europe, we move to UK, neighboring, I would say. Juliana joins us once again. Hi, Juliana. Good afternoon. The Competition and Markets Authority is investigating Google's Play Store rules. What's this about?
Good afternoon once again, Innie. Yes, well, this announcement by the UK's antitrust watchdog follows a long list of probes involving big tech titans and their dominance on the internet. And we know, of course, we all use the internet. Most of us have a smartphone. If it's not an Android, it's an Apple phone. And what the CMA have found after a year-long study is that Apple and Google have an unfair advantage on other innovative tech brands, particularly those that are coming out of Britain. What they have found, especially when it comes to Google Play, that some of the apps from British firms and other firms are just not compatible with its system. And the same way with Apple's. For most people that have an iPhone, you'll see that Safari is the main dominant browser. And if you try to use Google or another browser, according to the report, it just doesn't give you the same swiftness and accessibility as you would have with other apps. So they have launched an 18-month investigation starting from today. They're going to be speaking to a range of different players in the market. And as I said, this comes in a long list of probes that have been taking place, not only in Capitol Hill in Washington, but also in Brussels in the EU.
Yeah, well, we'll wait and see the results of that investigation, because I'm sure it will concern me also. But how's the market looking at this time?
Not great. Since early trading, the FTSE has dropped about 92 points. I think there are so many concerns in the UK about the spiralling cost of living crisis, as we've discussed extensively this week. Every day, petrol prices are reaching a record high. Earlier in the week, they reached over £100 just to fill an average family car, leading to motoring groups asking for the British government to put in some urgent intervention. That hasn't happened just yet, but we are expecting an announcement on fuel duty by the Chancellor later next week. So the FTSE All-Share goes into the weekend down by 1.16%. The FTSE 100 down 2, Innie, by 1.20%. And the FTSE 250, that domestic market, is down by 0.96%. In the currencies market, the British pound is also trailing behind the US dollar by 0.43% and down on the euro by 0.13% and down on the Japanese yen by 0.85%, Innie.
That's a lot of red, Juliana. I do hope that the market recovers, you know, over the weekend, and then we'll have at least a little bit of green by Monday. Thank you.
Lots of data expected. Oh, and I didn't mention the US data, which of course is making investors fret. We're expecting inflation to reach 8.3%.
Oh my, oh my! The world is going inflation everywhere. Thank you so much, Juliana. We sure have a lot to talk about next week and see how the market and other commodities will react to that. Let's move on now. Shares in Asia Pacific were mixed on Friday as Chinese inflation data for May came in largely in line with expectations. Investors also looked ahead to the release of U.S. inflation data. We just talked about it with Juliana just now. And Hong Kong's Hang Seng index slipped 0.29% to close at 21,806.18. In mainland China, the Shanghai Composite gained 1.42% to close at over 3,000 points, while the Shenzhen component jumped 1.9% to over 12,000. Japan's Nikkei 225 shared 1.49% to close at 27,824.29. As shares of SoftBank Group dropped more than 2%, while Topix Index declined more than 1%. South Korea's Kospi fell more than 1% to end the trading day at 2,595.87. The S&P AX 200 in Australia dipped 1.25%, closing at 6,932. MCSI's Broadex Index of Asia Pacific shares outside Japan dipped almost 1%. In the United States, futures were muted this morning ahead of the highly anticipated inflation report. Futures tied to the Dow Jones Industrial Average shared 38 points. Those for the S&P 500 rose fractionally, while the Nasdaq 100 futures gained 0.3%. Well, we have our correspondent, Mara Bed, to give a summary of how the market ended yesterday, some of the details as we await that inflation data.
The U.S. stock market took a sharp decline on Thursday, its worst day in 3 weeks. The Dow Jones was down by 1.93%, the S&P 500 down by 2.37%, and the Nasdaq was down by 2.74%. The tech industry took a major hit. Many investors are concerned that the inflation report that will be released on Friday will provide some insight to the Federal Reserve Bank that could create a hefty increase in interest rates. It is clear that investors are watching, and this could have a dramatic impact on the U.S. economy.
Yeah, everything certainly will have an impact on every economy, starting with that inflation data. Well, let's see what's happening in the oil space now. It rose slightly to trade near 3-month high. It hasn't left this corridor for a couple of days now. It was kept in check amid concern over new COVID-19 lockdown measures in Shanghai, outweighing solid demands for fuel in the world's top consumer. That's the United States. Brent crude futures for August went up 0.5% at $123.63 a barrel after a 0.4% decline the previous day. U.S. West Texas Intermediate crude futures for July climbed 42 cents to $121.94 a barrel. Initially, it had dropped 0.5%, where Shanghai and Beijing went back on a fresh COVID-19 alert yesterday after parts of China's largest economic hub imposed new lockdown restriction, and the city announced a round of mass testing for millions of residents. China's crude imports rose nearly 12% in May from a low base in a year earlier, although refiners are still battling high inventories with COVID-19 lockdowns and a slowing economy weighing on the fuel demand last month. In the metals market, gold edged down on Friday and was set for a weekly fall, with investors awaiting key monthly U.S. inflation data for cues on the future of the Federal Reserve's monetary policy. Spot gold eased 0.2% to $1,843.59 per ounce, while U.S. gold futures pulled back by 0.4% to $1,845.90. Or hawkish central banks, rising real rates and a stronger U.S. dollar have taken the shine off the gold markets. Withdrawal of unprecedented fiscal and monetary support is also weighing on sentiments. This week, we saw the GDP figures for South Africa, and it indicated that the rand strengthened, riding on a better than expected growth of the economy in the first quarter, while a surprisingly large rate in Australia heightened global investor caution. Data also shows that South Africa's economy recovered to the level it was before COVID-19 pandemic, and that's in spite of some of the incidents that have taken place there. Well, we have Matt Kindiger now, practice lead SSA in front of you, joining us now to help us understand how South Africa has been able to achieve this in spite of some of the incidents they've had. Hi, Matt. Good afternoon.
Hi, good afternoon. Thanks for having me on the show.
Good to have you. Well, Matt, just before, this is unexpected because they've had the flood, they've had, the other incident that really took them back. They had a huge setback with COVID-19, and yet we see them going back to the pre-pandemic level. I don't think a lot of people saw this coming.
Yes, well, I would agree. We were not expecting, well, if you look back about a year ago, we were not expecting the South African economy to reach its pre-COVID level until 2024. And this is because the fundamentals for the economy were pretty weak. And, we did see the floods and the unrest last year really hampering growth in our view. But actually, a couple of factors have contributed to more upbeat growth than we were expecting. So the economy grew by 2.6% in the first quarter this year on a year-on-year basis. That's not seasonally adjusted, and there are a couple of reasons for this. One is that the services industry has done actually very well. It's exceeded the overall level of economic growth. There are a couple of specific industries. So transport and ICT have done very well, grew by about 6%. This reflects a sort of continued reopening of the economy, an increase in travel both domestically and internationally. But also the ICT industry is following a trend that we're seeing across sub-Saharan Africa of one of booming activity. And this is partly related to COVID, but also because of new investments in the sector. But crucially, what we've seen in South Africa is very strong credit growth that has supported private sector activity. Interest rates in South Africa remain close to record lows. So they were cut by the South African Reserve Bank during the onset of the COVID pandemic to support the economy. And we have seen a sort of delayed effect in terms of the benefit on borrowing. So costs of borrowing have been very low. Households, businesses have taken advantage of this to invest and spend, especially on services industries. So really it has supported that. We've also seen quite upbeat exports demand and better than expected government spending. And this is because of very high commodity prices. The government has been able to avoid the worst of its austerity measures as we were previously expecting. So the government has, delayed spending cuts and also delayed tax increases. So this has provided some relief for the economy in the first quarter of this year.
Yeah, so do you see this trend continuing, looking at the outlook now?
So yes, in terms of the outlook, we actually have recently revised up our growth forecast for South Africa in 2022. We were previously forecasting about 1.7% for the full year. Now closer to 2.5 or 2.7%. And the first quarter data really validates this view. And this is because global commodity prices are now expected to remain higher for much longer than we were previously expecting. South Africa is a huge exporter of iron ore, gold, minerals, and demand and prices for these exports are really going through the roof. They will remain higher for longer because of the Ukraine conflict, which in our view will last well into 2023. So South Africa's exports will benefit. We'll also see lingering benefits on public finances because the government's royalty revenues from the mining industry in particular will benefit. But the outlook for 2023 and 2024 is a lot less certain. We are expecting growth of only about 1.2% in 2023 and the next couple of years. So we're expecting a slowdown because as commodity prices begin to ease, especially in the second half of 2023, and interest rates continue to increase, so the South African Reserve Bank will be consistently raising interest rates over the next 6 to 12 months, in our view. This will begin to choke off the very strong credit growth that we've seen in the economy. We also have, power shortages and rising inflation and a weak tourism outlook, which will also
constrain. Yeah, the power shortages in Eskom and all of that, that's also another level. But what about the rand? We see that it also strengthened. Do we expect it to continue performing that way?
In short, yes. So we do expect the rand to remain strong and quite stable for the rest of the year, although we can't rule out some volatility. There are many factors that will be pulling the rand closer or strengthening the rand over the next 6 months in our view. Firstly, export revenues, demand for South Africa's exports going through the roof. This will result in an influx of foreign currency into the market, so contributing significantly to a stronger currency. Also, as previously mentioned, the South African Reserve Bank will raise interest rates without very much convincing. And this is because as inflation increases and the rand is at more risk because of rising interest rates in the US and in the Eurozone, there's going to be much more pressure to make sure that the rand doesn't depreciate. So interest rates higher, commodity prices certainly will contribute to the rand stability. But as we look to 2023, we're actually expecting a bit of a reversal of this trend. As the election of 2024 gets a bit closer and as commodity prices ease, we are going to see the rand probably begin to fall, probably the first half or especially the second half of 2023 to closer to 16.5 or 17 per dollar. So the outlook for the rand is less certain the longer we look ahead, and we're likely to see much more volatility and depreciation, especially in 2023.
Yeah, Matt, I understand that. I mean, I know what the Naira is going through now with in a pre-election year. That always has a whole lot of impact. Well, thank you so much, Practice Leader, Sub-Saharan Africa, with a front of you. Thank you so much, Matt Kiniga. Enjoy your weekend.
My pleasure, you too.
Two other stories on the continent. Algeria said that it is suspending foreign trade in products and services with Spain. The move comes after the country suspended a 20-year-old friendship treaty with Spain that committed the two sides to cooperate in controlling migration flows and also banned imports from Spain. Madrid and Algiers have signed the deal in 2002 to promote dialogue and cooperation on political, economic, financial, education, and defense issues. The EU has urged Algeria to reverse its decision, pressing for dialogue to resolve the dispute. In Nigeria, money market indicators by the Central Bank of Nigeria shows that the gap between the savings and lending rates in the banking sector widened by 25.33% in March. Savings deposit rate was 1.28% in March, while the maximum lending rate was 26.61%. In February, the saving rate was 1.28%, while the lending rate was 26.61%. According to the figures, the savings rate stood at 1.25% in January, while lending rate was 30.73%. 45% of future jobs will be in the project management economy. This, according to the business development leader at Management Institute, PMI Africa, George Asamani, requires that individuals and businesses acquire and upskill skills. Mr. Asamani, who I spoke with earlier on our business show in the morning, Business Morning, believes that as the world rebuilds and reinvents, there's a historic investment in infrastructure development, projects, healthcare, climate change, fintech, and all this presents opportunities for innovation and employment.
The top 5 skills that companies who are moving into the future, project management is there. If you look at, some of the leading African research organizations that look at for the future of Africa, what are the top 5 skills? Project management is there. So certainly, in everyone's list of top 5 skills to have, whether you're a project manager or not, you should definitely be upskilling yourself from a project management perspective. Upskilling yourself could mean a number of things. It could mean you're actually looking for certification, going all the way to do, for example, the PMP, which is project management professional. You could go all the way from a certification perspective, or you could simply upskill yourself by getting some practice, getting involved in your with a local PMI chapter. For example, there's PMI Nigeria, so it's the chapter in Nigeria, Project Management Institute chapter. Get some practice there, join the community, and you don't necessarily have to certify, but just building that muscle of project management, looking at how do I think of scheduling, how do I think of risk management, how do I think of people management, what are my soft skills, what are my technical skills. All this is included in project management. And I mention this because actually, when people think of project management, they mostly think of scheduling management, but it's a lot more than scheduling management. It's also looking at, okay, what is the business case? What is my business acumen with respect to the work that I'm delivering?
And with that message and encouragement to upscale and acquire more skills, we say thank you so much for being a part of Business Incorporated today and for the week, though. We'll do it again next week. Don't forget, tomorrow, Capital Market, 7 p.m. We'll be here to give you activities in the market space and your outlook or expectations for the coming week. So 7 p.m., make it a date with us tomorrow here on Channels Television. For now, I'm Ini John McQuay. Enjoy your weekend.